If you began to see central bank participation in the silver market, I think you'd see much more upside volatility. Traditionally, silver has been of less use to central banks because, among other things, borrowing secured by silver on global markets hasn't been as generous or well established as the utilization of gold for collateral, as an example. Traditionally, the central bank's motivation has been as a store of wealth and a medium of exchange rather than for speculative purposes. Natives, just brutal speculative purchases. Right. It may be that Mr. Putin has observed the upside volatility of silver relative to gold.
2024 has been a strong year for silver, with many experts predicting it will continue to outperform gold in 2025, despite the potential slowdown in industrial demand due to a U.S. recession. Silver has consistently attracted attention from investors, especially when the broader precious metals market begins to rally. This trend is often fueled by silver's lower price and higher volatility, which makes it more appealing to retail buyers and emerging markets. According to Rick Rule, while silver's performance is often tied to gold's momentum, it gains significant traction as general investors look for more affordable ways to enter the market. Recently, silver received a major boost with Russia's announcement that it plans to add significant amounts of silver to its financial reserves. Historically, Russia, like China, has been a big buyer of gold, and while silver wasn't initially on the radar, this shift is seen as a potential game changer. Russia's decision to stockpile silver comes as part of its broader strategy to diversify away from the US dollar and other global financial systems, particularly after being isolated by sanctions. This move could signal a larger shift in how central banks view silver, with more institutions potentially adding it to their reserves. Rick Rule remains cautious, noting that silver has traditionally had a limited role in central bank holdings compared to gold. However, Russia's recent move suggests that silver's status in the global market could undergo a major transformation. If other countries follow Russia's example, we could see unprecedented volatility and price surges in the silver market, changing how silver is valued in the years to come. Now, we present the clips of Rick Rule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
My prognosis for silver has more to do with my experience, my observation. I don't, and I don't know anybody who does, really truly understand the silver market in terms of the why. I've been trying for 45 years. But what I do know how to do is observe. And my observation tells me that precious metals bull markets are led by gold. And when the generalist investor begins to be attracted to the precious metals narrative, normally because of the momentum established by gold, when that generalist investor comes into the metals market, leadership in the market transfers from gold to silver. So that transfer seems to take place sort of halfway through a bull market. And we haven't seen the transfer come to silver yet. And I don't know why the transfer does. I assume because of the reputation that silver has for more volatility, which attracts the greed buyer, and also for the lower unit cost, which attracts retail buying in emerging and frontier markets from holders who are unable to store wealth in gold. As I say, I don't know why it happens. I just know that it happens. The last to move traditionally have been the higher quality silver equities. And my observation has been that there is not enough market cap in that category to stand the inflow of generalist money when it happens. So the upside that occurs in the higher quality silver stocks is absolutely insane. To illustrate that, my first bull market was the 1970s, and I watched, but sadly didn't participate. As an example, Coeur d'Alene, going from 10 cents to $65. Not a typo. In the market in the early part of the 90s, I did participate. We financed Silver Standard at 72 cents. In 6 years, it was over $40. We financed Pan American at 50 cents. In 6 or 7 years, it was over $40. The upside that people who have the patience and the stomach to endure the volatility, the upside in the high quality, small silver equities is stunning. It isn't for people who aren't willing to hold a stock over a long weekend. You know, the narrative is a long-term narrative, and if you apply short-term tactics to a long-term narrative, you are your own victim. And I don't know if this is going to occur in a year or 2 years or 3 years. I don't even know that it's going to occur. I just know it's occurred 4 times before in my career. And the outperformance of silver and the silver equities relative to gold when the narrative comes into precious metals is truly spectacular. The fact that President Putin, or for that matter, President Trump, says something doesn't make it true. The cynical side of me says you can tell that politicians are lying when their lips are moving. We haven't seen any evidence of Russian participation, Russian central bank participation in the silver market, although it's possible that they're merely buying Russian production. If you began to see central bank participation in the silver market, then I think you'd see much more upside volatility. Traditionally, silver has been of less use to central banks because, among other things, borrowing secured by silver on global markets hasn't been as generous or well established as the utilization of gold for collateral, as an example. And traditionally, the central bank's motivation has been as a store of wealth and a medium of exchange rather than for speculative purposes. Natives, maybe that Mr. Putin has observed the upside volatility of silver relative to gold and has decided that he's a good speculator and that he should allocate the commonwealth of Russians to assets that he believes are going to go up in price. This has not traditionally been a central bank activity, but he's certainly not a traditional politician. We're a highly competitive society, but we aren't yet winning the race to the bottom. The Europeans are more efficient at debasing their currencies than we are, as are the Japanese, as are the Chinese, as are the Canadians, as are the Australians. I think we'll continue as the world's reserve currency, and I think that our currency will likely outcompete a composite basket of other currencies. I think there will be periods of time when other currencies are oversold relative to the US dollar. And I think that there will be opportunities for diversification for American investors into other currencies. But in direct answer to the question that you asked, I'm 71 years of age. I expect that the US dollar will be the world's reserve currency for the rest of my life. And for the record, I'm pretty healthy. And I think that on balance, if you compare the US dollar to other currencies, particularly the euro, that the US dollar will continue very strong. I think that rather than seeing a real BRICS currency, what you will see is a settlement mechanism outside of the US dollar for bilateral trade among countries that have learned that they can't trust the US. The Russians, certainly, who were victimized by our stealing $300 billion worth of their treasury securities. Whether or not you agree with their moves in the Ukraine, we did steal $300 billion worth of their assets, which doesn't engender trust. And nations that are concerned about the politicization of the SWIFT banking system, the ability of the US dollar to affect extraterritorial policy through US dollar exchange mechanisms. I think that you'll see bilateral relationships outside the US dollar. And I think that ultimately those flows will ironically settle in US dollars after the fact. I hope that helps.
Gold is on track for its best annual performance in over a decade, up 28% through November, driven by both central bank and investor demand. Despite a slowdown in consumer interest, the momentum has been largely sustained by steady Asian investment and the impact of lower yields and a weakening US dollar in Q3, which fueled Western investment flows. However, gold's remarkable performance is likely tied to its role as a hedge against rising market volatility and geopolitical risks. Since 2000, gold's price has surged from around $253 per ounce to nearly $2,700, reflecting a compounded return of 85% over 24 years, a testament to its ability to preserve wealth over time, particularly as inflation continues to erode the value of fiat currencies like the US dollar. The ongoing devaluation of the US dollar, particularly in housing, healthcare, and energy sectors, makes gold an essential hedge against inflation. While official inflation rates may suggest moderate price increases, these numbers don't fully capture the true erosion of purchasing power many individuals experience daily. Given the current economic climate, rising inflation, and potential market volatility, owning physical gold has become increasingly attractive for wealth preservation. Rule highlights that, even in the face of fluctuating gold prices, its role as a safeguard against the weakening dollar remains vital, positioning it as a prudent choice for investors seeking to protect their assets.
And I think a discussion needs to begin with a gauge of inflation that has to do with the living experience of your listeners, not a set of statistics conjured up by the Congressional Budget Office. I think that's very important. The work that's done by Shadow Stats, which measures inflation using the same metrics that inflation was measured by in the 1960s and 1970s, would suggest that annual inflation is worse than I describe it, that the deterioration of the purchasing power of the dollar measured by historic metrics is actually proceeding at more like 10 or 12%. I prefer to use 7.5% because that conforms more directly with the very crude measures of the deterioration of the purchasing power of my own savings. But irrespective of which number you use, I think it's important to understand that the 2.7 number is fiction. It has no relation to your listeners. And I think that leads into a discussion in terms of what we do about it of two topics. The first is that most people don't have enough private savings. Most people, I think, have been living beyond their means. Most people, I think, have their expectation of the future governed by their experience over the last 40 years, which saw declining real interest rates. And I don't think the people need to go or should curl up in the corner in fetal condition and say, you know what, I don't stand a chance. That doesn't work. But I do think that people need to maintain more liquidity, even though that liquidity costs them purchasing power. I think, too, that anybody who doesn't own physical gold is making a mistake. You don't have to own a lot. Traditionally, when gold performs, it performs so well that as insurance, a small premium buys a lot of coverage. I personally don't see a circumstance where the deterioration in the purchasing power of the US dollar on an absolute basis, not relative to other currencies, doesn't increase. That circumstance, history suggests that a prudent accumulation of gold is on order. In the very near term, on the gold theme, I think what we've seen is relative strength in the US dollar relative to other currencies, and I think that continues. I think the US dollar is, to quote Doug Casey, the prettiest mare in the slaughterhouse when you compare it to the euro, the yen, the Canadian dollar, the Australian dollar. It's on an absolute basis, US dollar savings for US investors, that it becomes problematic. I mean, we saw softness in gold as a consequence of investor confidence in the US dollar with the Trump election. And I think that you've begun to see that euphoria retreat from the trade. I think one of the problems that gold bugs have is that they remember the period early 1976 to 1981, where the gold price went up sixfold or sevenfold in 5 years. From my viewpoint, I'm not looking at gold as a way to enjoy capital gains. I'm looking at gold as a way to maintain my purchasing power. So for me, when people say, when is gold going to move? I say, I think it's going to move beginning in the year 2000. In 2000, it was $253 an ounce. Now it's $2,700. That's 8.5% compounded for 24 years. I don't measure it in weeks or months. I'm old enough to remember in the decade of the 70s when the perception of inflation lagged the reality of inflation for 4 or 5 years. The writing was on the wall in terms of the deterioration of the purchasing power of the US dollar beginning in 1967. The writing on the wall didn't translate into consumer action until 1972, 5 years or 6 years after the problem had been identified. I think what happened then is, and I'm making this up, by the way, I'm a credit guy, not an economist, certainly not a behavioral psychologist, But the period 1946 to 2067 was a pretty benign time. You know, the end of World War II, the lowering of interest rates, US dollar hegemony on a global basis, the Nifty 50, people were trained to buy the dips. I think we've been through the same period in 1982 to 2022, a 40-year period of really benign economic climate. And I think people's expectations of the future were set by their experience in the past. I don't think the world's going to hell in a handbasket, but I think that the period we have in front of us for the next 10 or 15 years is substantially less benign than what we've existed in for the last 40 years. I hope that long-winded explanation makes sense. Beginning about 8 months ago, you began to see retail participation in the gold market. Prior to that, for 2 years, all the strength in the gold market was central bank buying. If you look at inflows into ETFs, retail participation in the gold market didn't begin until 8 months ago. Over the last 2 months, you've seen retail dishoarding in the gold ETFs, a flow of funds out, not in. But you haven't seen any cessation of central bank buying. So you saw a transfer of gold holdings from European and North American retail holders to non-US central banks, which is to say the buyer that supported gold for the last 2.5 years has stepped back in the market, including the Chinese. What I think you're going to see next week is that the exodus of retail holders of gold, as measured by funds flows into the ETFs, will have turned around too. It may not be positive, it may be neutral, but I think that what you're seeing is that retail disintermediation out of gold has ended, while continued central bank buying of gold will continue to take the quote higher.
Although gold and silver are projected to see significant gains, silver is garnering particular attention from experts like Robert Kiyosaki, who has called it the best asset of the moment. Kiyosaki predicts that silver could reach $50 per ounce, driven by its growing industrial demand and appeal as a safe haven investment. This potential surge is largely tied to the increasing need for silver in green energy technologies, such as solar panels and electric vehicles, fueling the metal's consumption and putting upward pressure on its price. The World Silver Survey 2024 from the Silver Institute further supports this outlook, noting that silver's price is being influenced by rising demand from sectors related to the energy transition. Although the report doesn't specify an exact price, the ongoing demand, coupled with silver's limited supply, suggests that its value could continue to climb in the medium to long term. This trend highlights silver's increasing role in both technological advancements and as a store of value, making it a promising investment with long-term growth potential. Please share your thoughts on Rick's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.